Welcome back to FluxFolio Finance, your portal to the hidden mechanics of global capital. Today, we descend into the shadowy cathedrals of Wall Street, where multi-billion-dollar decisions are made in milliseconds, and fortunes shift with a whisper. We're talking hedge funds, those elusive titans that stir markets, sculpt risk, and sometimes bring the entire system to the edge. So, what exactly is a hedge fund? You've heard the name. It conjures images of glass towers, insider whispers, and impossible trades. To some, it's where billionaires park their wealth. To others, it's the engine room of financial innovation, and occasionally, destruction. Strip away the mystery, and at its core, a hedge fund is a private investment partnership. Exclusive, aggressive, and built for one thing: absolute return. That means profit in any market, rising or falling, stable or storming. These are not your grandmother's mutual funds. Hedge funds don't just bet on growth, they bet on collapse. On volatility. On geopolitical instability. On everything the traditional investor fears. Imagine them as financial warships, sleek, lethal, and unrestricted by the rules that govern the average vessel. The managers at the helm, names like Ken Griffin, Ray Dalio, Izzy Englander, aren't just traders. They're strategists. Architects of capital velocity. And when they move, the earth beneath markets trembles. They charge what's famously called 2 and 22% of assets as a management fee, plus 20% of any profits. It's expensive. But when you can turn $1 billion into $3 billion with a leveraged bet on Eurodollar futures or a collapsing currency, it becomes a fee most institutions are still willing to pay. Let's rewind to a legendary moment. In 2008, while the world burned in subprime chaos, John Paulson shorted the housing market, and made $20 billion. In a single move, he didn't just win. He rewrote the rules of engagement. But the battlefield is littered with fallen kings. Long-term capital management in 1998 nearly blew up the global banking system. Archegos Capital in 2021 used extreme leverage and lost $20 billion in days, taking Credit Suisse down with it. That brings us to now, and one of the most dangerous strategies ever embraced by hedge funds, the basis trade. This isn't a household term. But it should be. The basis trade exploits minuscule price gaps between U.S. Treasury bonds and their corresponding futures. It's simple in theory: buy the bond, short the future, and profit when they converge. But the devil isn't in the logic. It's in the leverage. Because to make pennies look like dollars, hedge funds borrow massively, often 50 to 1 or higher. Citadel, Millennium, ExodusPoint, Point72, these names dominate the trade. They're not just participants. They are the market. By late 2024, basis trade volumes were pushing $317 billion. At their peak? $352 billion. Meanwhile, leveraged short positions on Treasury futures hit $826 billion. And here's the catch: nearly 70% of this activity comes from just 10 hedge funds. Citadel's Wellington Fund returned 15% in 2024. Millennium clocked in with another 15%. D.E. Shaw's Oculus Fund? A jaw-dropping 36.1%. But behind those numbers were billions leveraged on razor-thin spreads, backed by borrowed money and gut-level conviction. And then came April 2025. Tariff shock. Treasury yield spike. Swap spreads exploded to 64 basis points. The unwind was swift and brutal. Forced deleveraging tore through the market. Treasury yield surged past 4.5%. Billions evaporated in hours. It was the closest thing to 2020's dash for cash, but this time, the Fed stood still. No $1.6 trillion bond bailout. Just pain. The Bank for International Settlements has warned, these trades, many bilateral and unregulated, are the quiet tinder beneath the $26 trillion Treasury market. And if multiple funds run for the exit at once, it won't be a correction. It'll be a firestorm. Yet this is the hedge fund ethos. Hedge funds don't just play the game. They build side bets on the game itself. Some engage in activist investing, buying stakes in companies to force leadership change. Others scan emerging markets for mispriced chaos. Many build positions in the dark, hidden through options, swaps, and offshore affiliates. Some even wager against currencies. In 1992, George Soros shorted the British pound and forced the UK out of the exchange rate mechanism. He made $1 billion in a day, and became the man who broke the Bank of England. So, what are hedge funds? They're risk machines. They arbitrage inefficiencies. They surf volatility. They hedge exposure and chase edge. They thrive in disorder. But here's what they are not: invincible. When fear floods the system, even the titans bleed. When too many pile into the same trade, be it meme stocks, crypto, or basis trades, the herd turns fragile. Liquidity disappears. Margins get called. And what once looked like genius suddenly looks like hubris. They are not villains. They are not saviors. They are instruments, reflections of our most aggressive capitalist impulses, operating in the deepest corners of the market's subconscious. So next time you see a sudden flash crash, or a bizarre spike in volatility, or gold swinging wildly as treasuries shake, pause and ask, is this just the market? Or is this a hedge fund moving the world? That's it for today's deep dive on FluxFolio Finance. If your mind's spinning, you're not alone. Hit that like button, subscribe, and ring the bell, because we're just getting started. In our next video, we explore how hedge funds are betting on artificial intelligence, global decoupling, and war. Drop a comment: genius? Madness? Or both? Until next time, stay sharp and follow the flows.